All right, let's dive right in. Today, we're breaking down an analysis that predicts a massive financial shockwave is on its way. And according to this source, it's not a matter of if, but when. The epicenter of it all? Japan. So let's get into what's going on.
So the source we're looking at today doesn't pull any punches. It kicks things off with this stunner of a quote, painting a picture of just incredible speed and scale. It's predicting a sell-off that it says is not just possible, it's practically inevitable.
And that really gets to the heart of it, doesn't it? Could a crisis in just one country's bond market really trigger a domino effect that takes down the entire global financial system? Well, that's the big question we're exploring today.
So where does this whole story start? According to the source, the fuse was lit by a very specific political promise made in Japan, one that sent an immediate and powerful shockwave right through its financial markets.
Okay, just look at this number, 237%. That is Japan's government debt compared to its entire economic output for a year. I mean, think about that. The country owes more than double what it produces annually. The source argues that a debt load this massive makes an economy incredibly fragile, like a pile of dry tinder just waiting for a spark.
And here's that spark. The source points to this specific political moment, a promise of big tax cuts and more government spending, but with no real plan to pay for it. The bond market, the people who actually lend the government all that money, they didn't just flinch, they freaked out. Bond yields, which are basically the interest rate the government has to pay, they didn't just creep up, they absolutely exploded in a single day.
Now, let's look at how this all supposedly fits together. The source claims this wasn't some random out-of-the-blue event. Nope. It says this fits a predictable pattern, a four-phase cycle that's been seen 17 times before whenever a major economy starts to lose control of its borrowing. And this is the core framework right here. Phase 1, foundation, that's when all the unsustainable debt gets built up. Phase 2, reliance, is when the whole system gets hooked on super low interest rates to survive. Phase 3, rupture, well, that's the moment it all breaks. And Phase 4, spread, is when the crisis escapes and goes global. So the really crucial point here is the difference in speed. The first two phases, foundation and reliance, they can take decades to build. It's a slow burn, almost boring. But the last two, rupture and spread, the source describes them as happening with terrifying speed. We're talking days, even hours. It's like a slow build-up to a sudden violent collapse. And if you're thinking, okay, but has this actually happened before? Well, the source points to two pretty recent examples. It argues that by looking at what went down in the UK and Greece, we can see a clear blueprint for what it predicts is happening in Japan as we speak. Just look at this timeline. This is a perfect example of that Phase 3 rupture speed. In the UK back in 2022, it took less than a month to go from a budget announcement to the Prime Minister resigning. The whole thing was driven by the bond market completely losing its cool. The crisis unfolded in days, not years.
And this chart really puts those numbers into perspective. This is the source's central concern, laid out visually. If Greece at 129% debt to GDP and the UK at 100% could trigger these massive crises, what in the world does Japan's 237% mean for the potential scale of this thing?
And the Greek crisis from 2010 gives us the lesson for Phase 4, spread. Remember that? The problem didn't just stay in Greece. It was like a financial virus, jumping to Portugal, then Spain, then Italy, and it threatened the entire Eurozone. It's this idea of contagion that the source is really zeroing in on. Okay, so with that history lesson in mind, let's bring it all back to Japan right now. The source takes this historical framework and applies it directly to the events it claims are unfolding, arguing that we're at the most critical point in the cycle. So according to this analysis, Japan isn't at the beginning of the story, it's already deep into it. The debt foundation, built over decades. The reliance on the central bank to keep things afloat, that was policy for years. And that political announcement we talked about, well, that triggered the rupture. So, the source argues we are now entering Phase 4, the global spread. So how exactly does a problem in Japan's bond market end up on your doorstep? The source lays out a very specific chain reaction, and it all starts with who owns America's debt.
$1 trillion. That's the key number here. Japanese investors, we're talking banks, pension funds, insurance companies, they are the single largest foreign holders of US Treasury bonds. They own over $1 trillion worth, making them an absolute cornerstone of the American debt market.
And here's the trigger mechanism. As interest rates start rising back home in Japan, it suddenly makes way more sense for those Japanese investors to sell their US bonds and bring that cash home. Now, when your biggest buyer suddenly becomes a massive seller, US bond prices fall and their yields shoot up. And why does that matter? Because US Treasury yields are the benchmark that's used to price almost every single financial asset on the planet.
And this is the potential fallout. If you're wondering what that means for, say, your stock portfolio, the source calculates that if US Treasury yields keep climbing, a simple reevaluation of the S&P 500 could lead to a 27% drop. That's how a bond problem in Japan becomes a stock market problem everywhere else.
And it doesn't just stop with stocks. No. The source argues the ripple effects will slam corporate debt, currencies like the yen, global real estate as mortgage rates everywhere climb, and emerging markets as money flees to safety. It's a full-on cascade effect.
So, what's the final conclusion from this whole analysis? Well, the source directly takes on the most common arguments against this scenario and lays out what it sees as the only logical course of action.
Now, the source anticipates that people might be skeptical. You might be thinking, but wait, doesn't Japan owe the money to itself? Or can't their central bank just print more money? Well, it argues that the first idea is a myth, that limitless money printing just creates runaway inflation, and that anyone dismissing this as just political noise is missing the huge structural debt problem underneath.
So, based on this pretty grim forecast, the source proposes a specific defensive playbook. Now, it is absolutely crucial to state this is the perspective from the source material we're analyzing. This is not financial advice. It suggests a major shift away from long-term assets like bonds and stocks and moving toward things like cash and physical gold.
And this is the powerful statement the source leaves us with. It's not framed as a prediction of something that might happen. It's presented as a confident declaration of an event that it believes is already in motion and will be looked back on as a historic, unavoidable turning point.
So, there you have it. The source has laid out a clear, four-phase pattern, arguing that history, the data, and current events all seem to be pointing in one direction. It leaves us with a final and pretty provocative question. Is this just a theory, or are we actually watching a predictable financial crisis play out right before our very eyes?